$700,000 house or keep renting at $2,500 per month? Which makes more sense? Most people never run the numbers. They just follow what everyone else is doing. So today, with the help of my rent versus buy edition of Home Buying Planner, I'm running the real math behind the exact scenario. By the end, you will see which option quietly builds more wealth for you and why the answer surprises most buyers. So let's start. This is the sheet which we are going to use to make the comparison. But there are certain steps that we need to follow to use this sheet in a correct manner. So if you see at the bottom, there are different tabs open in this planner. So we'll start with the mortgage pre-approval calculator. Here, if we are looking to buy a $700,000 home, so we'll put $700,000 over here. I just wanted to show you that if you move to the rent versus buy sheet, so here in this column that is buying a home, it will automatically pick the home price that we have put into the picture in the previous sheet. After that, we need to select how much down payment that we have saved to buy this home. Let's take an example that we have saved $50,000. Same way, if you go to the next sheet, it will autofill the down payment field that we have selected in the previous sheet. In the same way, we need to enter the interest rate that we are getting in today's market. So I'm assuming that we are getting 4% rate of interest, and amortization I'm taking 45 years. Yes, we can extend it up to 30 years if we can. So just wanted to explain you that these 4 inputs, what you are going to enter here, that will automatically be copied in these 4 cells. I hope that's clear till now. Okay, so I have already explained the working of these sheets in one of my previous videos. I'm also providing the link of that video in this one. So this mortgage pre-approval calculator, from here we got to know that if we want to buy a $700,000 house with $50,000 of down payment, we need at least $153,000 of annual income to get approved from a lender. Whereas the ideal income required to comfortably afford this home is $187,000. Okay, so we'll move to the next sheet where we'll do the actual comparison. Now, these left side are the input fields, whereas these 4 cells which I've already explained are logged. So these all options are if we are buying a home, that does this property generate rental income? So if the property that you are looking to buy have any potential of earning some rental income for you, it can be by way of just renting one room in the whole house to somebody else, or if it has a basement that you're looking to rent it out, it can be in any way. Okay, so we will be seeing how we need to use that. So let's suppose if it's no, you can select no, and if it's yes, from the drop down you can select yes as well. Okay, I'll show you how it will be impacting our calculations. So if it's $1,000, $500, $1,500, whatever you're expecting to get as your monthly rental income, you need to input that over here. This is not the rent that you'll be paying. This is the rent that you're expecting to get from the house that you're looking to buy. Okay, so moving on to the next one is a vacancy rate. What's the vacancy rate? It means that if you are looking to rent out a portion of the house or even a room, so it might happen that out of the 12 months in an year, might be 2 months are vacant because you are searching for a tenant. Okay, so we need to put what can be a vacancy rate. So ideally, at least we assume that 5% can be the vacancy rate. Now come on to the next one, which is renting. Now, if we keep on renting, we are paying $2,500 per month as rent. So next is rent increase. Obviously, if you're renting each year, whatever the contract or lease agreement you are entering into with your landlord, there is a certain percentage increase of the rent each year. I'm assuming that there will be at least 2% per annum increase in your rent. Okay. Now, in the time horizon means that in how many years you want to see this comparison. Like if you want to see if you keep renting for 2 years or 5 years or 10 years, how much rent you are going to pay as compared to if you buy the home. Okay. So 2 years is a very short time. For this example, I put 5 years into the perspective. So we will be comparing that if you keep on renting for 5 years, how it will be different from buying a home in 5 years. So I'll be putting 5 years into perspective. Now this input section is very important. So here it is a different scenario that you can compare with. So if you can see, there are 3 different scenarios which I have put into this calculator. So it is conservative, base, and optimistic. So what happens is, if you are buying a home, obviously there is an expected home appreciation rate associated with that. So here in these scenarios, we have to input how much we are expecting the home price to appreciate each year. If we go by some facts, so Canadian home prices have appreciated with an average annual growth of approximately 5.7 to 6% in the last 20 years. But for this example, I'm taking that on a conservative side, your home value can grow up to 2%. Base scenario, I'm taking 3%. Optimistic, I'm assuming that it can grow 4% per annum. Now here, what's that? That is expected investment return. Now here, what we'll be also comparing is the opportunity cost of the savings or the down payment that you are looking to buy a home. Here we will be comparing that instead of putting that $50,000 towards buying a home, what if you keep renting and invest those $50,000 at different rate of returns? Okay, so in the very first scenario, in the conservative, I'm expecting that if you get 4% per annum rate of return on $50,000 that you have saved, in the base scenario, I'm expecting it to be 6%, and in the optimistic, I'm expecting it to be 8%. Okay, so here in this drop down, we need to select different scenarios. So in the drop down, if you click, you can select conservative, you can select optimistic, you can select the base scenario. So depending upon what the scenario you are selecting, all the calculations are based on these percentages. So if I have selected base scenario, which means my calculations are based that it is now calculating that property value will be appreciating 3% each year. And if we invest the $50,000 down payment somewhere else, we will be getting at least 6% per annum return. Okay, I hope everything is clear till now. The real comparison part will begin from here. So this portion will be giving you the facts or actual numbers if you buy this home, and this portion is giving you the data if you rent and invest your down payment. This is comparison based upon real numbers and real facts. You won't get a better and a detailed comparison of rent versus buying anywhere else. Okay, now let's move on. So let's start with if you buy this house. Okay, so we are assuming that we are going to buy a $700,000 home with $50,000 of down payment at 4% interest and 25 years of amortization. Okay, so now based upon the scenario that we have selected, that our property appreciation is going to be at least 3% per annum, and 5 years is the time horizon that we are comparing for this example. So here what it is telling us that after 5 years, what's gonna be the price of your home. So if the value of the property keep growing at an average 3% per annum, $700,000 will be worth $811,500 after 5 years. So in the next column, it is telling us equity from appreciation. So what's the equity from the appreciation? It's your value that is after 5 years minus your purchase price. Okay, so this is the equity only from the appreciation of the property that you have generated. That is $111,500 after 5 years. Now, this is about the equity. Obviously, the buying comes with lot of expenses and costs associated with it. One of the very prominent cost is the mortgage that you're going to pay. Okay, so this planner particularly factors in all mortgage costs as well, not the hypothetical number, but the real principal plus interest number. How? I'll show you. So as I told you that there are multiple sheets available in this planner. So if you click on the bottom one, that is advanced mortgage amortization schedule. So here you can see it is calculating actual principal and interest amount that you're going to pay in a particular amount of time. How? So similar to what we started with mortgage pre-approval calculator, based upon these numbers, the purchase price and down payment, the mortgage required is this amount. After factoring in even your CMHC premium, that is $676,000 of mortgage you will be requiring to buy this home. Now, if you directly move to this amortization schedule sheet, so if you see, this sheet is automatically taken that mortgage amount from the very first sheet along with the interest rate and amortization. So now it will be making accurate calculation that if you buy this home on this mortgage, how much interest and principal you are going to pay in a particular amount of time. I hope it's clear to you. Now we'll move again to our comparison sheet. The principal amount that you are going to pay in 5 years is $87,516. The total interest that you are going to pay on your mortgage is $125,838. So see, this planner is factoring in your actual mortgage cost. in this rent versus buy comparison. Now, the next, what you will be paying if you buy a home: utilities and maintenance. For this comparison, we are assuming the utilities and maintenance of the house to be 2% of your purchase price each year, which means if you are buying $700,000 home, you will be at least paying maintenance and utilities of $14,000 each year. Now, what's the next cost when buying a home? That is your property tax. So for this calculation, we have taken 0.75% of the purchase price to be the annual property tax for this comparison. That in 5 years, the property tax you will be paying will be around $26,250. Yes, there can be a bit difference in the actual property tax, but for this assumption, we have taken very close to the actual one, that is 0.75% of the house price. So moving to the next cost, that is your closing cost. When you are buying a home, you need to pay the closing cost. Okay, for this comparison, we have taken 2% of the purchase price to be your at least closing cost. So 2% of $700,000 is $14,000. Now the next is condo fees. So in case you are buying a property which has a maintenance fee and a monthly condo fee, so this planner also factors in that fees as well. How? So simply for inputting that, you just need to move to the previous sheet. So all major inputting fields are on this first sheet. For example, just to show you, I'm not taking the condo fee for this comparison, but in case when you're using this calculator, you want to factor in the condo fee, you just need to input your condo fee here. Assuming it's $400 a month, so you'll just put $400. And now I'll show you that if you move to this one, it is automatically taking how much total condo fee that you'll be paying in 5 years. So if $400 is a monthly condo fee, you will be paying $24,000 in 5 years as your maintenance. Okay. But for this comparison, I'm not assuming it to be a condominium that you're buying. So let's move to the next one. So this rental income, which we were discussing previously. So yes, here, in case that we are expecting some rental income from this property, so we'll simply switch it to yes. So if you see, when we have selected yes, on the basis of $1,000 per month rent expectation with 5% of the vacancy rate, it is calculating that how much total rent we are expecting to earn in the 5 years. That is $57,000. The calculator has already factored in this rental income. No other planner in that detail will factor in these rental incomes when making this comparison. So this is just to show you that how you can factor in rental income. I'll take this calculation in this comparison at the end of this video, but for meanwhile, I'm assuming that there is no rental income for this house. Here at the bottom, it is now giving you a snapshot. What's the snapshot? That what is the total cash out? Like when you are buying this home, how much actual money you are going to spend out of your pocket that will go out as an expense. So I explain you how it has calculated this $236,088. In the total cash out, we will be taking all our expenses. Okay, so interest that we paid is our expense. So $125,838 plus utilities and maintenance is also our expense. $70,000. Property tax is also an expense. $26,250. And then the closing cost is also a one-time expense when buying a home. That is $14,000. So see, $236,088 is the total cash out when buying this home in 5 years only. So we are comparing for the 5 years. Okay. So now the next one is total equity. That how much total equity you are going to get after 5 years for that. So how it is calculating total equity? So it is calculating, the very first one is the appreciation from the value of the house, that is $111,500. Plus down payment that you put to buy this home is also the part of your equity. That's a capital that you have invested from your own income. So plus $50,000, that is your equity. Then plus the principal amount that you paid out of the total mortgage amount that you paid is also your equity. That is $87,516. So $249,016 is the total equity that you're going to made after 5 years of buying this house. So this is the net worth change. How this is calculated? It's simple. Total equity minus total cash out, that is $12,928 is your total net worth change after 5 years when you are buying this home. So here the statement also says that means housing had a net profit of $12,928 over 5 years before selling. Before selling is a very important word here. It is, we are now comparing that you are keeping this house, you are not selling this house. Because when you're selling this house, you know that there are selling costs as well, which are associated to that. We are not factoring in this comparison. Yes, we have factored in those expenses in the next calculation, which are more detailed. I'll be explaining you, but this 5 years comparison is assuming that you are not planning to sell your house in next 5 years. Okay, I hope everything is clear till now. Now move to the next one. That is, if you keep on renting at $2,500 per month, and the $50,000 which you have saved, if you invest that money at 6% as per the scenario we have selected, how it will be different from buying a house. So down payment growth means if you get a 6% per annum, your $50,000 will become $66,900 after 5 years. Total investment growth is your total amount which will be after 5 years minus your initial investment, that is $50,000. So total profit that you'll be getting is $16,900 from the investments. But how much rent you will be end up paying in 5 years? That is $156,122 total cash out. In the rent scenario, only the rent that you paid from your pocket is your total cash out. That is $156,122. Total equity, including the amount you invested plus the growth that you got, is $66,900. The difference of both these two is minus $89,222, which means that if you keep on renting for 5 years and invest your $50,000 down payment, your renting will be having a net cost of $89,222 over 5 years period against a net profit of $12,928. This is how you can compare each scenario. You can make the changes, like in case there is a rental income you're expecting. I'm just now factoring in your rental income. So I put yes over here. So if you see now, the difference has gone up, where your buying will be having a net profit of around $70,000 in 5 years if you manage to get a rental income of even $1,000 a month out of it. And here is the graphic representation that where the money went in 5 years. Okay, hope everything is clear from here. Now you can also change the scenarios over here. If you are expecting the property price to appreciate at the rate of 4% per annum, then you can select optimistic scenario. That will further change your calculations. Or if you are expecting property prices not to grow at that higher rate, you can select a conservative and see what the impact will be. And you can always change the scenarios. If you want optimistic to be 5%, you can change it. You can make these changes and calculate how the buying will be different from renting in a particular set of time, that is 5 years. You can change it to 10 years, 15 years, 25 years, whatever the years you want the comparison to be. Okay, I hope it's clear to you. Okay, now comes the best part of this planner, is the break-even analysis. If you just scroll it down, so if you can see here, it is the break-even analysis of renting versus buying. Now, what does that mean to you? So again, I explained till here that this analysis is if you keep your property, if you are not looking to sell your property. But break-even analysis also factors in your selling cost when you're selling a property, because that's a considerable part of equity you are giving when you are selling your house. So how the net buy has been calculated, I'll explain you from the example we have taken over here. Okay, so over here, as per the base scenario, in the 5 years, the net worth change, like our profit was $12,928. If we come here on the year 5, here the net buy is $27,648. That is in minus, which means after 5 years, if we want to sell this house, we won't be able to break even. So if you go down a bit low here, it's a detailed chart that in 25 years, how much your home value is going to be, equity, rental income, principal paid. So all the components have been bifurcated in detail in the below of this sheet. So if you see in the very last, there is a column of selling cost. So how the selling cost has been calculated? It has been calculated as 5% of the value of the house in the year you're gonna sell this house, or in the year you are gonna compare that if you are gonna sell this house. So here we are looking at 5 years. So after 5 years, if you're gonna sell this house, you will approximately will be having a selling cost of $40,575. Okay, so we'll move ahead just to make you explain how that figure has been achieved. So after 5 years here, the net buy is 27,648. So now I'll show you how this has been achieved. So here after 5 years, if we don't sell the house, our profit would be $12,928 that we calculated. But what if we want to sell? So if we want to sell, as per this sheet, we will have to pay around 5% of the home price at that point of time as the closing cost, which is $40,575. So if I minus that from that figure, so this is the actual outcome is going to be, that is $27,648, which has been calculated here. So just wanted to explain you that this net buy figure is also taking into consideration your selling cost, and net rent is simply the amount of rent you paid minus the return on your investment that you initially invested. So in this case is $89,222, which was also there when we were comparing 5 years in the above sheet. So what else it will be telling you? So if you scroll it to the bottom, now it is telling you that in which year buying beats the rent. That is, after 3 years, you will be seeing that your buying is better as compared to renting. How? Because if we see here, in 3 years, the difference between net buy and net rent has started becoming positive, which here means that buying will be better than renting after 3 years. But if you are looking from the perspective of ownership break even, then you have to keep this property for at least 11 years to produce positive outcome of the cash flow for you. So if you see in 11 years, if you try to sell this house after 11 years, you will end up having $11,796 back in your pocket. So this is giving you all not only a simple break-even analysis, but also telling you then when buying will be beating renting. And if you are considering this from perspective of an investment, after how many years you will be able to break even. So a message is also here, if you are considering this house to sell before year 3 from the perspective of renting versus buying comparison, then buying is not an optimal option for you, because it will take 3 years for buying to outperform renting. And that's the graphical representation of the figures. So net worth outcome in 5 years before selling. So here figures that we have compared what will be the total cash out, total equity, and the total net worth change. And here it is showing you over 25 years of amortization, where the net buying is going and what will be the impact of net rent. So I just want to show you how a small changes can just change the whole scenario, where the buying can be way better than renting. So very first change is if the property is generating some rental income. If there is a rental income even of $1,000 a month, so just see here that buying is now beating rent in the very second year. And even if we compare from the perspective of investment or home ownership break even, after 2 years, your buying is way better than renting. Okay. And one more hack, let's assume that there is no rental income. So we'll put no over here. And if we go down, as we see that your buying is better than renting after 3 years and ownership break even is 11 year, how to make it better? So just go in your advanced amortization schedule. So here, if you see, the default payment frequency is monthly, because all the lenders, until and unless you don't ask them, will give you a monthly payment frequency. But if you just switch it to accelerated bi-weekly or weekly payments, I'll show you how it will make a better impact on this comparison. So if I select accelerated bi-weekly, so if we go into rent versus buy, so see, home ownership break even, which previously was breaking even in 11 years, now it will only take 6 years to break even as far as ownership break even is concerned. Why? Because in the initial 10-15 years of a mortgage, your interest costs are higher than the principal that you'll be paying. So in the initial years, you pay most of the interest to the lender and the lesser of the principal. But if you switch your mortgage payments to accelerated bi-weekly, it helps you to reduce your interest expense and increase your equity in the house. So this is one way that you can opt to make your buying better than rent. Okay. So again, you can make all other type of changes. So this break-even analysis can be maximum up to 30 years of amortization, which is also the highest amortization you can select. So if we want to compare for 30 years, we just need to go to this sheet, put 30 years here, 30 years amortization, and this sheet will automatically expand to 30 years. Now it will be showing you that in how many years buying will be better from renting, and in how many years the break-even ownership here can be achieved. Okay, I hope it is clear till now. And as I showed you previously as well, if you go below that, there is a whole chart on year-to-year calculation basis. That's a bifurcation on the yearly basis, that what will be your home value after whatever there you want to check after 5, 6, 7, 15 or 20 years, how much equity you will be getting. If there is a rental income, how much rental income you're going to get, how much principal is paid, how much interest is paid, how much utilities you're going to pay in a number of years, how many taxes, condo fees, and selling cost. And here, if you scroll, it is how much rent you're going to pay in n number of years, your down payment growth, how much it's going to grow at a certain percentage selected in the scenario, and what will be the investment growth. If you are somebody who are looking to buy a home and want to do a comparison, this sheet is for you. Or even if you are a person who are looking to buy a property from the investment point of view and want to see whether it will be a profitable thing to buy this home or no, you can also use this planner. I'm putting the link of this planner in the description of this video. The same link is also available in my bio. I hope this video has provided value to you. If this video has provided you value, please don't forget to like this video and subscribe to my channel.